Canada is facing a mounting debt crisis, similar to what has been happening in the United States. Household debt, mortgage loans, auto loans, and credit card balances are record highs, and the increasing cost of living continues to intensify this financial strain. While debt has been a tool for economic growth and consumer spending for years, the low interest rate environment that encourages this borrowing is starting to show cracks. As rates climb, the Bank of Canada constantly raising the interest rates to combat inflation. Canadians are feeling the pressure from all angles. How did Canada accumulate so much debt? In recent decades, Canada has experienced a marked increase in debt levels, largely fueled by persistently low interest rates that have reached an encouraging environment for borrowing. As these rates sank to historic lows, Canadians seized the opportunity to invest in real estate, triggering an unprecedented boom in the housing market. Individuals and families across the country were eager to secure low cost mortgages, driving demand for properties to new heights and pushing home prices up dramatically. Nevertheless, the allure of affordable financing options extend well beyond just the housing market. Canadians found themselves increasingly drawn to the convenience of credit cards, engaging in consumer spending and resulting in significant accumulation of credit card debt. In addition to this, many individuals opted to take out auto loans to finance the purchase of a new vehicle, while others secured personal loans for a wide variety of consumer goods and services that they desired. The flourishing borrowing culture escalated as financial sector adapted to meet the rising demand for debt. By introducing an extensive range of loan products aimed at attracting consumers that offering them straightforward access to much needed funds, consequently complicated network of financial obligation has now developed, prompting critical decisions regarding a long-term viability of maintaining such elevated levels of debt within Canada's household. Throughout this period, we witnessed a dramatic surge in housing prices, particularly in bustling metropolitan areas such as Vancouver and Toronto, where the demand for real estate seems insatiable. Many Canadians came to the perceived real estate not just as a form of shelter, but rather as a stable and secure investment opportunity, which further fueled the frenzy in demand. As housing markets continued to surge to unprecedented heights, a rise of warning signs began to surface, indicating looming instability that could impact countless individuals and families. Home prices reached a staggering levels, becoming alarmingly overinflated and well beyond the financial capabilities of the average household's income. This troubling trend has significant ramifications. As a result, an even growing number of Canadians now find themselves obligated to allocate a substantial portion of their monthly income towards covering hefty mortgage payments. This pressing reality leaves them significantly diminished financial flexibility, creating obstacles that make it increasingly challenging to set aside savings for future aspirations or unforeseen expenses that may arise in the face of this mounting pressure. The delicate balance of financial security for many families at risk, calling into question their sustainability of the current market dynamics. Another significant element influencing the current economic landscape is the consumer spending behavior observed among the different generations. Traditionally, older generations tend to place a higher value on savings and earnings, often prioritizing long-term financial security over immediate pleasure. In stark contrast, younger Canadians tend to indulge in spending in the present with the belief that savings can be addressed at a later time. This culture shift towards seeking instant gratification has been exacerbated with widespread availability for credit, leading to a scenario where Canada is increasingly characterized as a nation of borrowers rather than savers. Recent statistics reveal a concerning trend: a majority of Canadians lacking emergency funds, which is crucial for navigating unexpected expenses, such as car repairs or medical bills. This lack of financial preparedness is compounded by the persistently low savings rate, which, when joined against the backdrop of high consumer debt levels, set the stage for a precarious financial environment. This situation becomes even more alarming in the context of rising interest rates, as individuals find themselves trapped in a cycle of debt with little or no safety net to cushion the impact of unforeseen financial setbacks. At the heart of this debt crisis lies the prolonged period of historically low interest rates. Following the global financial crisis of 2008, central banks around the world, including the Bank of Canada, slashed interest rates to stimulate economic recovery. Low rates make borrowing more attractive, and consumers, as well as businesses, responded by taking on more debt. The thinking was simple: With money so cheap to borrow, why not take out loans to buy homes, cars, or even invest in businesses? For a time, this strategy worked. The Canadian economy rebounded and the housing market boomed. However, the downside of this prolonged period of low interest rates is now becoming evident. As interest rates rise, the cost of servicing the massive debt burden becomes more expensive. Many Canadians who took out variable rate mortgages or lines of credit are now seeing their monthly payments increase significantly. In some cases, homeowners are struggling to keep up with these higher payments, especially in cities where housing prices are already sky high. Additionally, the impact of rising rates extends beyond the mortgages. The cost of other forms of debt, such as auto loans, personal loans, and credit card debt, also increases. Many Canadians, particularly those with high levels of consumer debt, are starting to feel the pinch. As rates continue to rise, the financial burden will become heavier, lending to higher rates of delinquency and defaults. Rising rates and the impact on the housing market. The Canadian housing market has long been a major driver of economic growth. However, with interest rates now on the rise, the market is beginning to cool. Home prices, which were once skyrocketing, are starting to level off or in some cases decline. For many Canadians who bought homes at the peak of the market, this is concerning. If housing prices continue to drop, homeowners could find themselves in a situation where their mortgages are higher than the value of the homes, an issue known as being underwater. In addition to cooling home prices, the rising rates are making it more difficult for potential buyers to enter the market. With higher mortgage rates, the cost of buying a home has increased, pricing out many would be buyers. This reduced demand could put further downward pressure on home prices. Moreover, with the Bank of Canada signaling that it may continue rising rates to fight inflation, the outlook of the housing market remains uncertain. A prolonged period of high rates could lead to significant correction in home prices, particularly in the overheated markets like Vancouver and Toronto. Inflation and the cost of living compounding the problem is rising inflation. The cost of living in Canada has increasingly dramatically over the past few years, with food, gas, and housing becoming more expensive. While wages have risen, they have not kept pace with the inflation, leaving many Canadians feeling the squeeze. The combination of higher prices and the rising interest rates is creating a perfect storm for households already stretched thin by debt. Inflation is particularly harmful for those with fixed incomes or those whose wages are not keeping up with the rising cost of goods and services. As inflation erodes purchasing power, Canadians are forced to spend more just to maintain their standard of living. This in turn reduces the amount of money available for saving or paying down debt, further exacerbating the debt problem. Government debt and physical responsibility is not just households that are struggling with debt. Governments in Canada are also heavily indebted. The Canadian government took on significant debt during COVID-19 pandemic to provide economic relief to businesses as well as individuals. While this stimulus helped stabilize the economy during the time of crisis, it also contributed to the country's ballooning national debt. As with household debt rising, interest rates will increase the cost of servicing government debt. This means that a large portion of the federal budget will go toward interest payments, leaving less room for spending on essential services like healthcare, education, and infrastructure. If the government is forced to cut spending or raise taxes to address the debt, it could further slow the economy. How can Canadians protect themselves? Glad you asked that. Given the uncertain economic environment, many Canadians are wondering how they can protect themselves from the looming debt crisis. One strategy is to focus on paying down high interest debt as quickly as possible. This includes credit card debt, which typically carries some of the highest interest rates. By reducing the amount of money owed, Canadians can limit the impact of rising rates on their financial well-being. Another strategy is to invest in assets that can provide a hedge against inflation. Peter Schiff, an economist and financial commentator, suggests that during inflationary periods, it's important to own real assets like commodities, value stocks. Commodities like gold, in particular, have historically performed well during times of high inflation. Gold is seen as a safe haven because it maintains its value, even as purchasing power of the paper currency declines. Value stock companies with strong fundamentals that generate steady earnings are another good option. These companies tend to perform well during inflationary periods because they provide products or services that consumers continue to buy even as prices rise. In contrast, highly prospective companies for those with inflated stock prices may see their values decline as interest rates rise and economy slows. Looking ahead, the future of Canada's economy is uncertain. Much will depend on the Bank of Canada's manages interest rates and inflation. If rates continue to rise, economy could slow significantly, leading to higher unemployment and a possible recession. On the other hand, if the Bank of Canada eases off on rate hikes, inflation could continue to erode the purchasing power of the Canadians. Ultimately, the key to navigating this uncertain future is being financially prepared. Canadians need to focus on reducing debt, building savings, and investing in assets that can weather economic storms. While the debt crisis may be unavoidable, taking proactive steps can help mitigate its impact on your financial future. In conclusion, Canada's debt crisis is multifaceted issues that affects individuals, businesses, and the government. The combination of rising interest rates, higher levels of consumer debt, and inflation is creating challenges environment for many Canadians. However, by focusing on financial discipline, the smart investment Canadians can protect themselves from the worst effects of the crisis and ensure a more stable financial future. If you found this video helpful, don't forget to leave a like, share your thoughts in the comments. Be sure to subscribe so you never miss out on our latest updates. Thanks for watching.